So in this video, I'll be sharing my low risk versus high risk, high quality versus low quality matrix with you, which will help you identify how to grade your own setups, which is fundamental to avoiding high risk, low quality setups. Because how do you avoid something if you can't even define it? My name is Samkela Mfega, and this is The Modern Day Trader. We're transparently sharing what works, what doesn't work, all to hopefully help you on your path of becoming a consistently profitable trader. If you've been following the daily nuggets, then you know that I'm in a 13 trade losing streak. Now, to my defense, that's only translated to a 5.5% drawdown, which speaks to really good risk management, because I always knew that it was possible to take multiple losses in a row. I think up to 20. I just didn't think how probable it would be, but I guess for whatever reason, that was a good decision taken back then. And I think that's something traders don't think about enough. We always think about, how many trades it will take to pass a challenge or get a payout, but how often do you think about how many trades it will take to reach your maximum drawdown or loan account? Trading is more, akin to risk management as opposed to maximizing profit. And if you try to do one without the other, then more likely than not, you'll end up blowing the account or reaching max drawdown. Now, what I didn't actually plan for was how my trading needs to shift or adjust when I am this deep into drawdown, because my current plan just says that I should continue trading the plan and it will ultimately self-correct, which did happen when I was in phase 2. I was in a 4.5% drawdown, I think, and I didn't change anything. I just carried on trading the plan and it did self-correct. I think this time it's a bit different. There's money on the table and I'm becoming more aware of how it just becomes a very slippery slope to digging this hole for yourself. Every losing trade almost feels personal. Every missed trade, you're beating yourself up afterwards, and that becomes really hard, or puts you in a position where it becomes very hard to objectively determine what trades are actually good quality or bad quality, because you're in the state of mind where you're now trading really in a fear-based condition and you don't want to miss trades. And so you're just taking setups that meet the plan, mindlessly, and whether that trade is, high quality or low quality or high risk or low risk, you just don't want to miss the plan. And so you end up taking all these setups, which I suspect have been low quality, high risk setups, and that is no way to dig yourself out of recovery. So here are, I guess, 4 simple steps that I'm taking to recover this drawdown, which does in fact deviate from the plan, but my future self might thank me. So the first is that I'm limiting myself to 1 trade per day. Now, look, I take about 3 trades per week on average. So I don't think this will be too difficult, but I think something like this is just good to have in the plan because it avoids, excessive executions in those weeks where there are an abundance of setups. And so 1 trade per day can only enter an additional position once I'm at break even on that position. I'm only considering low risk, high quality setups. We'll get to what those look like in a little bit. I'll only be taking the more conservative reduced risk entries, which are entries that wait for displacement first and then enter on the limit order once price retraces. And if I do reach a 7.5% drawdown, then I'm going to reduce my risk to 2.5% or 0.25% per trade, as opposed to the current 0.5% risk. So before we get into the matrix, I've struggled a lot with differentiating, what risk versus quality actually looks like when it gets to your plan. And that's been a key component of building out this matrix. And so shout out to ChatGPT for clarifying this, because I didn't have no idea, but I was struggling to confidently determine the difference. And so when you look at it, it says risk is about how exposed you are if the trade goes wrong. It answers how likely is it that the setup fails based on structure and timing. And so how I think about that is a trade will initially be high risk, in my plan, depending on the depth of correction, if we're at 50%. And so that trade can either sell off, if this is a bearish structure, from that point at the high risk point, which can happen, or it can continue to correct, ultimately become lower risk, sell off from there, or then continue to correct and ultimately shift structure, and then it becomes invalid. And so positions or price often trades from high risk areas to, I guess, lower risk areas, to then either validating that structure or invalidating that structure. And I think the less experience you have, the more you get caught up in the impatience of just trying to catch a setup so that it doesn't leave without you. And so it becomes hard to wait for setups to become low risk. And sometimes it's not necessary to wait for setups to get to low risk. It depends on the context. But I think that's just helped me clearly define how to view risk in this sense, whereas quality is more about how clean the setup is. So it answers how well does this trade align with, my edge, process, and price behavior. And, giving an analogy, a high risk trade might look good, but, comes early or, during a news announcement or without full confirmation. And so there is a certain degree of risk there because the plan is not met fully on paper. Whereas a low quality trade might meet your rules on paper, but something just feels off, messy structure, weak reaction, unclear path. So, it's got unclear inducement, or, it induces like it's breaking the structure. And so you're not sure, where is this an inducement? Is the structure actually shifting? It's technically met your plan, but, you take it, it stops you out. Or you take the trade, but, looking at where your target area is, there's so many obstacles or, POIs or key indicator areas en route to that TP that it just lowers the quality of the overall position playing out because, it's got all these corrective obstacles in the way. And so when I look at it then, obviously the best trades hypothetically to take are low risk, high quality, because like it says, it's got clean structure, strong confirmation, minimal exposure. The worst, high quality, high risk, low quality. Those are often, messy, rushed, and likely emotion driven. So let's break down this matrix. So now when you look at it, what I almost want you to think about, or a way that I've thought about it now, is that if you look at this low risk, high quality, which is almost the optimal combination, that can be considered, these high probability positions. And then when you look at a combination of either low risk, low quality, high risk, high quality, high risk, low quality, that I think can be considered as, valid positions. And you might be able to even, grade within that grade. Some people like to do higher quality valid, low quality valid. But, I'm just not there yet. I think I'm just trying to establish whether the parameters that I've identified and how I've defined it are actually accurate. So looking at low risk, or we'll start from the aspects. These are basically the different parameters that, I look at when I think about setup identification right down to execution. So for our nature, your 1 hour range, inducement, your POI, your entry type, news environment, execution timing, and risk to reward. So when looking at the low risk category, your 4 hour nature is impulsive with clear swing points. Your 1 hour range has corrected into that premium with discount 62% region, and your inducement will follow after the mitigation of the POI, because you can have inducement post or prior to that, or as it mitigates the POI, which is more on the high risk side. So for example, on this chart, if we've got this order block here, if this price had to come into there and then it's a bit wild, and then mitigate within that POI, that's more low risk because we've gotten the inducement within the structure. But, for example, before we even mitigate that area, we sweep that point as we mitigate the area, and that is our inducement. Then that's more of the high risk variation of, the inducement. Our POI or key indicator area, low risk, it's unmitigated, it's a clear area. And even in that, I think clear as opposed to questionable on the high risk side will look a bit different for all of us, because that is largely shaped by my own experience, what I've seen and what I've seen play out over time, and what I would say is, low risk or high risk. And so I think that obviously involves a bit of discretion within that description. We'll try to make it mechanical over time, but that's why I've also had, put in there it's unmitigated, just to have some sort of objective criteria, as opposed to having previously been mitigated before the entry. Same, I guess, period of or pocket of price. We had, this fair value gap there, came up. First time we mitigated, price pushed up nicely. We ultimately did come back and mitigated some there. You see the second mitigation, which was on this candle, kind of blew straight through there and violated it. So the first mitigation always has, I guess, the highest chance of playing out. And that's, what I want to consider when I'm looking at high risk, low risk. News environment, no news within 15 minutes of execution, low risk. Execution well within the session, risk to reward 1:3 within the 1 hour range. So effectively what this means is, if, for example, I'm looking at this range, the low, the high, and for example, let's say this didn't, sweep the lows there, and price was just contained, I would look for my 1:3 to play out before that equal high is achieved. It can play out after. I think it becomes a bit uncertain beyond that point as to where price will expand to in that sort of discovery zone within the range we're playing in before the next deeper pullback. And so I think it's just more certain that you will see those equal range highs or lows, and you want to, as far as possible, try to keep your target within there. But if you're playing a larger structure, then it's acceptable for it to fall out of that. It just means that you're more prone to deeper corrections once we've tapped into those equal highs or lows. And so the corrective, which we've kind of looked at, our 4-hour nature is choppy and very corrective. We've only achieved 50% within that 1 hour range. The inducement occurs as the POI is mitigated. POI has also been previously mitigated and questionable. Entry type is our risk entry. And then news within 15 minutes of restricted news, because technically I only need to look for, I only restrict or need to restrict my entries within 2 minutes of high impact news. But before would keep this to 15 anyway, just to avoid that, that volatility. Execution, I guess, outside of defined sessions, which rarely happens, unless I'm holding an order that was placed within the session. So I set a limit order and then, the session ends, but everything's still valid about the position. I can hold that for another hour. And so I guess it just becomes a bit more high risk there, because I've defined the sessions for a reason. Or it's kind of just very early or very late into the session. I'd say very early is riskier, because you're getting a lot of protractions and inducements there. And so that's put in there. And then 1:3 with the target outside of current range. So now that defines our low risk, high risk, which is more so, making sure that your plan is met to, to the clearest degree. And even within that plan, there's certain parameters that play out better than others, such as, within the 1 hour range, and, your risk to reward ratio. And so when looking at the quality now, which is more just how has the variation of price formed in alignment with your plan, when looking at the 4-hour nature, we'll see in higher quality positions, us being corrective when price is pulling back, and then impulsive when we break out, as a trend should be. When you see price, correcting in the direction of your trend, for example, here, clearly correcting lower, and then ultimately impulsing as it comes higher, clear trend. When we start correcting in the direction that should be the trend and impulsing in the direction that should be the correction, then you can start to get a sense that something's shifting. Our inducement, or our 1 hour range rather, when price reacts to the zone, with structure, and then it forms post mitigation, I think that just speaks again to that corrective retracement. We tap into a POI. It's not a very volatile touch and go, and then price just, shoots away. We tap, we get consolidation, we get that inducement, clear structure forming on the 15-minute to complement that. And then the inducement itself, clear inducement followed by displacement. I think that's clear. You want to see same, I guess, POI example. Ideally, price breaks in, we have a bit, clear inducement, and then shift to the upside. I think what makes this lower quality is, extended inducement. For example, same example, we induce there, but then, price, let's say, comes just very deep into that POI, and we then, it looks more like a continuation to the downside, an impulse after a correction than an inducement. And then, even then, say, for example, if we just take away all of that, price is inducing and we get the sweep, break higher, we take the entry, and then price comes back and sweeps, what should have been that last swing point. I think that just lowers the quality of the position. And you may notice that with the quality metrics, some of these you'll only realize after you've taken a position, or in hindsight when you're journaling. And so you might not be aware of all the factors as you place a trade, but it's going to give you good data to work with in your journaling sessions to then go back and review and say, okay, this was low risk, but how did it play out in terms of quality? And I think that can start to validate or invalidate some of your low risk, high risk criteria. And then looking at the POI, key indicator areas, with the POI, you want that mean threshold tested but respected. And then with the high risk, it's just a very deep mitigation. And so when I'm talking about mean threshold, for those of you who don't know, the 50% point of your key indicator area will be your mean threshold. And what you want to see is price playing preferably above, or, in a bearish scenario, below that area. And we might, chop a bit in between there, but then ultimately we push away from that point. Because once you start, coming in and you chop and then you break below and then starts to chop there and maybe test the low, then this area it's good for nothing at that point, because price is clearly trading in and out of there without a clear sort of reaction from that point. And I think that just goes back to some of the mechanics around, why an area is identified and why you're technically looking to take price from that area. And so, when looking at now entry type, swing point holds, swing point does not hold for high and low quality. That goes back to the inducement. Is that point you took the trade off? Could you have placed your stop above or below that swing point and it would have held? Or did price come and, retest that 15-minute high or low again and, form deeper? And obviously it will do that sometimes, but yeah, that's how I've defined it for this purpose. And then, with news, for example, now, Trump administration coming in this year, we've had multiple wars, Russia, Ukraine conflict, Iran, Israel, the States getting involved there. That's a very unstable, geopolitical field. And naturally, you will expect market conditions to not be so great in that time. Does that mean there's no opportunities? No. But it gives you a bit of awareness around what's happening. Does that mean I'm not going to trade now? No, it won't. And that's maybe where I'll violate the plan a bit here, because we don't know how long those things are going to play out for. And I'm, not going to sit on the sidelines until, a war's over. Next thing, it's like Russia, Ukraine, and you're sitting on the sidelines for how many years? I think it's more like, if there's US elections today, am I going to take a trade today? No, obviously not. Things like that. Execution timing, entry aligned with session momentum and timing, or entry during transition, or reactive to volatility. I think it speaks a bit to the risk grading. And then the risk to reward, efficient delivery to target in a high quality setup with room for some active management within that range or beyond. And then I think something that's a bit low quality is just looking at the range of price that your trade needs to play out in. Are there obstacles there? Is there a chance that price is going to reverse from any of those points? I think that lowers the quality of the position. So something I'll be doing, which I urge you guys to do as well, once you've established what your own matrix looks like based on your plan and strategy, is go over the last 20 to 30 positions, and I want you to identify which trades in there are both high risk and low quality. And I know that these are setups that I don't want in my plan at all, or I don't want to be executing on, even if they do meet the plan on paper. Please like this video and subscribe to this channel if I provided you with any value whatsoever. And let me know in the comments below, what you think of this matrix. What would you do differently? This is a work in progress, but I know some of you have probably already cracked this. So let me know. And remember, guys, consistency is the choice you make when you start doing the things you should be doing day in and day out.